So I think I'm supposed to open and welcome you all here to the Class Action Money and Ethics 2019 conference. So I'll just start by saying that this is the third year that I have participated in the conference, and I found the first 2 years were absolutely fantastic. We have an amazing program again this year. I think that you'll find you're going to learn a lot today. The sessions are all really terrific. The way that this is structured is to have the panelists give comments, but then we really open it up, and there's always a lot of good conversation, so I think you're all going to enjoy that. I wanted to start out by thanking the sponsors, BRG, Huntington, Lord, Batea, Simploris, Knowledge Partner, and Pacer Monitor are the sponsors for the conference, so please join me in thanking them for making this possible. And I'm also going to thank Jeff Clank, who's here from BRG, because he did an amazing job putting together a lot of these sessions, so thank you very much, Jeff. And also the Beard Group, Peter Chapman and Bernard Tolliver, who are in the back, and of course they also worked extremely hard putting this together for us, so thank you. Okay, so we have 8 different sessions. You have the program. I think today's going to be an amazing day. We have a keynote that will be given by the Honorable Jed Rakoff. And so I think the lunch will be extremely interesting. And then I understand there's a reception that will follow in the dinner. So if you don't have the information on that, please get the information from the reception. And with that, I'm going to turn it over to Chris Ritchie.
Thank you, Rob. So on behalf of Huntington Bank, welcome. We're really pleased that you can all join us today, and we're particularly happy about the turnout. This is the third year for the Class Action Money and Ethics Conference, and it's the largest. So we're really happy that you all could join us, and we're particularly pleased to see so many friends and clients here in the room. I do want to underscore what Robin said about the work that Jeff did. There was a significant amount of effort put into the program, developing the panels and lining up the speakers, and we really appreciate all of his hard work. Now let's get started with our first panel on class action financing and bring up Liz Lambert from Huntington, Christine Azar from Burford, Marc Rose from Pomerantz, Brent Landau from Hausfeld, and Dan Chai from BRG.
So good morning, everybody. My name is Dan Chai. Glad to be here. I flew up from Boston last night, and I'm glad to see the sun for the very first time in about 2 weeks. So for anybody coming in or living on the East Coast, this is a beautiful day to have the third annual conference. I'm going to get right down a very, very quick introduction of the panelists, and we're going to dive right into, I think, a topic that is really evolved at least here in the U.S., greatly over the last several years. To my immediate right is Brent Landau. He is the managing partner for the Hausfeld firm handling antitrust litigation. And at the risk of putting Brent too much in the spotlight, hot off the presses, Law 360 just named Brent Landau a titan of the plaintiff's bar. Capital T. And to Brent's right is Marc Gross. He's the former managing partner, global managing partner for the Pomerantz firm. Marc has handled securities fraud litigations for more than 40 years. To Marc's right Christine Azar is a director at Burford Capital, which is a leading publicly traded third-party funding firm. Christine leads a lot of their business development and origination efforts on behalf of Burford. And at the end is Liz Lambert, who is a senior VP at the Huntington Bank. Huntington provides more traditional senior bank financing to class action litigation, and we'll certainly talk about the distinction between what she does and, for example, what Christine does at Burford. So I'll just end on that, and the first question I want to actually tee up for the panel, I will aim for Christine. Do you want to just kind of tell the audience generally, give a brief overview of litigation funding, the markets in general?
Sure, happy to. So litigation funding from our perspective is really about investing in an asset class, and that asset class is litigation. And a lot of people don't think of it that way, but if you start to think of it that way, you understand a little bit more about what it is that we do. And when we look at the asset of a particular litigation or multiple litigations and do the deep dive, then pricing is all about risk allocation, whether we're taking all or part of the risk of the litigation. And so when you think about it that way, that sort of tees it up. Now, most people think of litigation funding as a single case situation where the funder is paying the attorney's fees and all the out-of-pocket expenses for some upside in the recovery down the road. And that is certainly a big part of what we do and what our competitors do as well. And so when we look at that single case financing, we can pay all of the attorney's fees, we can pay part of the attorney's fees, we can pay expenses only. There are a lot of different ways to structure it. We also can come in at any stage of the case. So we can come in before the case is filed, we can come in partway through, we can come in on appeal, we can come in post-settlement. And if you think about it in those different scenarios, the risk changes. So a case before it is filed is the riskiest and thus the most expensive. Post-settlement is the least riskiest and thus the cheapest. And then there are stages along the way. So if a case gets past a motion to dismiss, if we come in after that, it's going to be more competitively priced than earlier, or post-class certification. And so in the single case situation, we can kind of step in, negotiate with the clients really to what their needs are. And that's the way we look at it, is sit down, what are the problem points, what is the capital going to be used for, and negotiate accordingly. From that scenario, the next thing that we can do a lot of are what we call portfolio financings. So that would be multiple cases. And in that situation, it might be a institutional investor that is a class member in many different securities class actions. And in that situation, we can pool those cases together. They are cross-collateralized and therefore less risky, and the pricing is more competitive. So we do that a lot. We also do that with corporate clients where they have a lot of litigation, some of it affirmative, some of it defensive. We can provide the capital against all of those cases, get a return out of the affirmative cases. Their risk is shifted largely to us, takes that off their balance sheet, all that legal spend, and we get a return out of the back end. So that's sort of the two client side ways that we do it. We can do single case, we can do portfolio case. I mentioned post-settlement. We actually have a newly launched fund that is dedicated completely to post-settlement. So in the class action situation, what we see a lot, particularly on the law firm side, is a case is settled, an objector has appealed, it could be 2-3 years before you see the money. So we can come in, evaluate that situation, and offer to monetize a part of that fee. In some cases, monetize a part of the client award as well if they have kind of a large holding in a particular stock or a large antitrust matter and the like. We at Burford, and I can't speak to all other funders, we fund large commercial cases, so antitrust, securities, business-on-business disputes, international arbitrations, cases like that. We don't fund largely in what is kind of called the consumer side, but there are lots of other situations that do. We also fund directly with law firms. So kind of like Liz works with law firms and provides bank financing, we do financing to law firms, maybe to grow their business or to monetize some of their future fee awards. All our financing is non-recourse, and that's why I say it's about risk allocation, because we're assuming the risk because if the case is not successful, we do not get paid. And so, a lot of people will say that our capital is more expensive than Liz's capital, and it probably is, but that's for a reason. And so, on the law firm side, we can again structure deals multiple different ways where we're providing financing against the future fee awards that you expect. We also do year-end, basically factoring of accounts receivable. So if a law firm has a lot of receivables that are coming in the first quarter and they want to monetize that into year-end, we can do that as well. We also have a very robust judgment collection practice and asset recovery. So there are, a lot of corporations sometimes that have judgments and they just kind of don't want to spend the money to go out and collect on them. They can shift that to us, and we can go out and collect judgments as well. So I don't know if that answers your entire question. I could
Yeah,
go
no,
on and on.
that was really good. I just want to add one thing generally is that we'd like to run this, in a very, very Socratic way. So if anybody has questions, please just raise your hand and feel free to chime in. I just want to follow up a little bit about the post-settlement kind of activities, and maybe that's a good segue into what Liz does as a leader in Huntington's national settlement team, and maybe you can also then follow up that by talking about kind of comparing and contrasting the senior bank financing with traditional funding that Christine just described.
Sure. Thank you, Dan. Well, what I can say is Christine and I have actually worked together on a few deals, so we do complement and supplement each other well. We're not necessarily head-to-head competitors, which is a nice thing, sitting on a panel together. I'm going to speak closer. So really the way Huntington's group approaches it is from a commercial standpoint for the law firm. There are other banks out there that may also approach it from a private banking standpoint and accommodate the needs of the firm almost as a supplemental thing to that. Really what we do is we address the needs of the law firm's cash flow needs. As cases are filed, going through the process through the court, they're taking longer and longer, especially with some of the empty seats on the judicial bench, to go through the settlement process. So it creates strong cash flow needs throughout cases they are now filing and then cases that have already settled. When we get involved with lending, we really consider them character loans. At the end of the day, the talent's walking out of the door every night. So we're looking at it truly from a senior debt perspective. We're taking a lien on the business assets of the firm, but again, those are limited. We're talking about relying on settlement funds that haven't yet paid to the firms. So those are truly under jurisdiction of the court. So you really can't truly perfect a lien in a settlement fund. So really what we're relying on is the judgment of the attorneys at each firm who have the expertise to choose which cases they want to spend time and money on and seek financing from us to help them carry them through the cash flow cycles, which can be very binary. It can be very challenging. So we really do typically revolving lines of credit, which are interest only, again, cash flow friendly. That way you can borrow while you need, pay down when you don't, borrow back up again when there's more cases and more expenses coming up. We typically are relying on unsecured payment guarantees as just an enhancement to the credit structure because, again, when the talent is committed to finding these cases, that's the important part to us is that there's an emotional commitment from the key equity owners and partners of the firms, but we're not looking at having any kind of collateral associated with those guarantees. It's more just about the emotional commitment coming from those partners and equity owners. We also tend to look at cash collection as a very important piece to the puzzle here. So some of our typical covenants will address semi-annual cash collections that come in against fees that were projected, as well as a borrowing base, which really ties the amount that can be available from a credit line to what is projected to be collected over the next 2 years. We understand it's a long operating cycle for these law firms. The partners and other associates are taking a substantial amount of risk when they're putting time and money into cases. We're relying on their expertise. We have absolutely no input and no say in how those cases go. We are just selectively lending to those firms where they've demonstrated a history of success in reaching settlements and getting paid. I think it's also important to recognize that these attorneys typically have meetings monthly, if not more frequently, to discuss their cases from what I'm gleaning from our clients. And that gives them a chance to really evaluate, are we putting our eggs in the right baskets? I think, part of the challenge is you might have many filed complaints at any given time, juggling a lot of balls at once. what's important is to know when to stop the bleeding on certain cases that just may not work out. And I think that the attorneys we're working with as clients have a very good sense of how things are going, how the judge is receiving certain issues that come up, and also how co-leads may think about it. And I think they kind of, rule together on how they want to proceed if a case is getting a little bit off track. So really, I think we do supplement each other. We're coming from the top of the balance sheet where you're, essentially coming from beneath, and we play well on that basis. And that's kind of the general.
2 points.
Absolutely, please.
So the first point is similar to what Liz is saying about how we evaluate who we work with. When we are diligencing a case, of course, the merits of the case are extremely important, but almost as important are who the lawyers are, because when we make our investment, as I said, it's non-recourse, so we have to trust that the people who are flying that plane are going to fly it well and that they're going to act in an economically rational manner. And so I think very similar to that, we are very selective on who we work with, especially on the attorney side, because that's going to be an extremely important part of our diligence into the case. The second point I wanted to make, and I think this is critically important, I know it, so I sometimes forget to say it. When we invest in a case, we have no control over that case. We are a passive investor. We monitor our investment. We want to know what's going on in the case, of course, but we have no say into when and how much it settles for. We have no say into how the case is run, which kind of goes back to point one, why it's so important who the lawyers are that are litigating the case, because similar to a bank, we have no say in how that case is run. And I think that's a very important point. It comes up a lot where people ask, well, if I get a litigation funder to come in, am I going to lose control over the case? And the answer is a emphatic no.
And,
I think.
Oh, sorry. I was just going to
Yes,
add.
sir. Oh, sorry.
That's okay.
Are non-recourse investments ethical in every state or other states? I'm from Texas.
Right.
Out of my state.
Texas is a little funky on the law firm side. So they have to be structured in a way where we are not getting a percentage of the recovery that the attorneys are. It varies somewhat from jurisdiction to jurisdiction, and we kind of, keep a real-time list of every jurisdiction to understand exactly what the parameters are. Largely, the answer is yes, it is ethical, and most jurisdictions are that way. There are a few that there are some nuances to that point, and so we kind of have to, in real time, keep up with that with all the court decisions that are coming out in the industry.
The other thing I was going to mention was as far as trends that we're seeing associated with class action plaintiffs' bar activity, typically you would see final approval, and then the attorney fees could potentially get paid at that point. But there's also now trends seeing where the judges are saying in the motions that part of the fees can be paid at that point, and then the rest may end up having to wait until distribution starts to class members. So that too can create a borrowing need, whether it's from a Burford Capital or Huntington Bank or others, because of the timing and delays, again, that are associated with these cases becoming more and more protracted. And even going so far as differentiating between antitrust and securities, we have two extremely well-versed attorneys on our panel that can speak to both of those verticals as well, because there are differences and nuances associated with antitrust being a bit more complex, typically multiple defendants, and then securities, which has a timeline that can potentially be more predictable at times, but it depends on the cases you're undertaking.
Yeah, so that's a very good opportunity to segue into Marc's comments and to Brent's comments. Just to quickly follow up on a common theme that Liz and Christine were talking about in terms of generally what we're talking about is risk management. And as an economist, when I think of risk management, I'm thinking about how do you manage or optimally manage uncertain outcomes. And when you're thinking about it from that perspective, we're talking about, are there nuances when you're diligencing, if that's even a verb, or doing the due diligence on the different types of cases? So I guess, Marc, on the securities fraud cases, can you maybe elaborate, for the audience, some specific or nuanced securities-related aspects or inputs, in a due diligence effort in terms of the merits of the case?
It's always asymmetrical at the beginning of the case, how to evaluate the strength of the case. We are looking essentially at public information, and a couple of objective measures are how much the stock price dropped, what was the stock, the analyst reactions, was there an indication at that time that there appeared to be an enormous surprise and a loss of trust because a sense of that they had been misled. So those are the types of things that we look at. Sometimes, you know, if we're bringing a case involving a pharmaceutical, if the company has been touting the fact that the test results have been superb, no problems, no adverse reactions, and then it turns out that several people in fact died, well, that suggests that not only were they should have been saying something differently, but they should have known also. So because we have to also not just show that they made a mistake, but they did so with intent or recklessness. So you have a financial restatement. That's sort of an easy lift, but we don't see that many. We've seen a number of cases more recently, like the Petrobras case or the BP case, where there's a sudden adverse development that suggests that the management has been misleading everybody along the way with regard to their own corporate governance. Are they in fact imposing or implementing the safety program that they had claimed to have been done to remedy all the past problems? Same thing with these dams that have been breaking down in South America. Petrobras, a company that was riddled with corruption but had told everybody before, well, we've taken care of this. So those are the kinds of things that we look at in evaluating the case. But I'm not quite, I think when it's come to working with Huntington, which has been our banker, and prior ones before that, it is very relational because we're kind of looking all into a crystal ball and trying to figure out, well, how are we going to ultimately convert a case into monetize it? You know, you had a Vivendi case which went to trial, had a $10 billion potential recovery and gets thrown out by the Supreme Court. So this is all contingency, but what we try to do is diversify our portfolio and try to ensure that we have enough small cases coming in and a few mega cases. And it's been an interesting path as I've been doing this for 40 years. When I started out in 1976, Abe Pomerantz, who had founded the firm in 1933, financed the firm by going into his bank vault and converting a treasury bill every once in a while when we ran out of cash. So that was a self-financing type of mode. Come along the 80s and the next generation of the firm, we started getting a line of credit, but it was a rather small line of credit, and it was dependent upon the relationship with that particular manager, Stan Grossman, my predecessor. When I took over in 2010, that bank and I did not have that same kind of relationship, and they not only they wanted to give us a smaller line of credit, that wasn't going to do it. Fortunately, I'd known Chris and Liz through work at the Institute of Law and Economic Policy, of which Chris is one of the officers. We put on seminars every year. And I guess it was fortuitous that we had been able to they had been able to step into our space and at that point give us a line of credit that was able to sustain us. Then along came a mega case, Petrobras. We knew that in order to run that case, we were going to have to hire over 100 additional attorneys. We knew that in order to satisfy Huntington, we would have to demonstrate not only our prior history, but that going forward we had a lot of controls. So we showed not only what our inventory was, but also what our controls over expenses were. And so it was a matter of becoming a very much a business person and less of a professional lawyer. It was quite a challenge. It made it very interesting for me personally and for the firm. But recognize, you know, we are on a plaintiff side entirely contingency. So we could not depend upon fees coming in regularly. They would come in haphazardly. Fortunately, Huntington was there. Then there came a point where we saw, well, this case is going forward. Judge Rakoff will be the luncheon speaker, certified the class. So we were pretty much off to the races at that point, needed more attorneys, needed more funds. Again, Huntington stepped up. There came a point where we said, okay, we're running at the end of the bit here. While we have other cases that are going to come in, At that point, Huntington said, okay, we'll give you a little more, but you have to have much more skin in the game. And it required a personal commitment, and we did it, and we were very grateful that we were given the opportunity. But fortunately, we were also able to pay down virtually the whole line, which was quite substantial, from the other cases that came in before Petrobras. So I think we were, we were, based upon having decades of experience, we were able to select good cases that ultimately converted, but nonetheless, it's a high degree of uncertainty. Having your bank behind you certainly gives you a level of comfort, but you still have to figure out how to manage. One of the things I'm curious, though, about is, as a reality check, I was in a case where my co-lead counsel needed to finance, and we did not finance through a third party. He therefore had to give up a greater portion of his fee. We are only paying an interest on our outstanding debt. So can you give us a reality check here as to what is it that a firm that can't get the senior financing, but chooses or has to go to the kind of litigation funding? What's the range of interest rates that we're talking about here? Is that something that you can talk about?
I could start
Sure.
just saying what we would do
Sure.
and then how you might supplement.
Sure.
So for the most part, the way we look at these law firms is we prefer a larger portfolio of cases happening at any one point in time. We don't want to have, one-hit wonders, two-hit wonders. So as Marc was saying, that's what enables the firm to repay while you're still litigating a protracted case such as Petrobras. And really what happened there was the self-discipline that I think we imposed upon you, hopefully was, in the end, worked out well, was creating 2 years' worth of monthly projections, cash flow and balance sheet, to show what was being deployed over time with the various attorneys that you had to create on the bench during those years, and then how things were going to pay down and maybe go up and down along the way. That gave us a great comfort that there was that demonstrated willingness and commitment to have the controller at the firm and the other partners involved with the case put together a very, what I would call, sophisticated form of projections. That really helped us a lot. So I give you a lot of credit for doing that. We were able to feel our way through that with the firm's help and provide the financing along the way and increase when necessary. Where I think Christine can certainly play a role is when maybe it's something that's a little less diversified, or there's generally more risk because it's maybe earlier in the stage's life cycle. It may not even gotten past motion to dismiss yet. So there are certain situations where I think what Burford provides adds quite a bit of value as well.
And I think to answer your question on sort of pricing, pre-settlement, we don't price based on an interest rate. It's typically two different ways you can structure a deal. It can be a monetization of future fees, so we would do the diligence and evaluate what we think the likely fee is that's going to come in and then monetize a portion of that. And then the recovery would be either a multiple to our investment or a percentage of the award or some hybrid thereof. We also do, and this would be more on the portfolio side, like Liz says, when you have a diversified portfolio, what we call a risk share. So we would be funding a certain amount of capital based on what we think each case is going to cost, and then we can pay, 50-50, it can be 70-30, it can be expenses only, whatever the firm is looking for, and then our recovery would be kind of along those same lines. Post-settlement, it is an interest rate. It varies depending on the, kind of the risks going forward on the settlement getting finally approved and paid out, but that's, going to be something that probably looks like a mid-teens interest rate.
And I was remiss in not saying what our senior debt financing rates would be. Typically interest only, anywhere from what's now considered LIBOR plus 1 to 3, 100 basis points over that. Right now, 1 month LIBOR is around 250 or so. So it's essentially, subprime rate financing. However, LIBOR is probably at some point, not too far from now, going to be out of commission, I guess, and a new rate scheme will come up. But it'll still be something that's most likely economically advantageous from that standpoint.
So that conversation just really underscored why litigation finance was really very interesting to me from the get-go, is that you see that it's marrying oftentimes high-stakes litigation with capital raising and finance, you see a lot of the recurring themes such as portfolio diversification, which is kind of like a modern theme in modern, in finance, that's creeping up into the litigation discussion. I know Brent has been sitting here really chomping at the bit to articulate his Titan credentials. But Brent, do you want to talk a little bit about nuances financing from the antitrust case perspective, and perhaps provide a case study, if you will?
Sure. Good morning, everyone. The best part about getting called on last on a panel like this is that I get to just agree with all the excellent points that everybody else has made, because, as Dan said, you do hear the same themes kind of over and over again through this. We're all talking about assessment of risk and management of risk. I often say that our business model is patience, that we wait a long time for cases to go from their start to their finish. That time horizon has gotten longer, not shorter, over recent years as the steps and the hurdles and the requirements of cases have gotten more and more time intensive and complex and expensive. And if we look at antitrust cases, the class certification phase of an antitrust class action has become more and more the central turning point of the case, and as a result of the way the law has gone, and good news for the economists in the room, it's gotten very, very expert focused, where the main determinant of whether a case gets certified or not often comes down to the strength of the econometric models, and those don't come cheap. And so as the case timelines get longer and the cases get more expensive, deciding how best to fund those costs over a very long period of time becomes one of the central questions of our business. And so the direction that we decide to go has to be based on a combination of what our assessment is of the risk, what is the cost of capital that it will take, and then importantly, what is the ethical landscape in the particular jurisdiction where we are, which may or may not put some constraints or directions into what we do. As far as the risk assessment is concerned, I wish I could say that it's a science, but of course it's much more like an art, and experience helps, but also, as others have said, diversification of a portfolio of cases is really the key consideration. I think that we're right most of the time when it comes to selecting which cases to be involved in and which cases to seek appointments as lead counsel. But the truth is, it can be quite difficult at the outset of the case when perhaps all you have is the fact that there's been a government investigation announced, or some guilty pleas, to know, well, how is the case really going to go? How is leadership going to turn out? What's going to be required in terms of the economic analysis, not to mention all the traditional types of merits-based questions through discovery. So being able to know that even if we're wrong once in a while, we've got plenty of other cases where we're right, that's what is really the thing that makes the business work. As you've also heard, there are various sources of capital. One, of course, is just to take the capital and the resources and the revenues of the firm and its partners. Not everyone can visit the bank vault and take out the treasury note, but the truth is that many of us do, to some extent, maybe a little, maybe a lot, finance the cases that we do out of the other revenues that are coming in. That can actually turn out to be a very expensive form of capital if you're using after-tax dollars to do that, but of course that needs to be part of it, not just to manage the risk, but also to have skin in the game ourselves, which we always do. And then in choosing between different types of external financing, again, it's not a one-size-fits-all situation. As you've heard, senior bank financing is going to be less expensive capital than third-party litigation funding. You're also getting something extra with the third-party funding that you're not getting with the senior bank funding, which is the non-recourse element of it, which can be quite important. Then again, if we're choosing cases that we believe are going to be successful, then the risks associated with recourse financing are less, because since we're managing risks all along anyway, if we're doing it well, already limited the downside on the recourse side. That having been said, there are certainly situations when it makes sense to outsource some of the risk to a third party, and that's why third-party funding has such an important role. At our firm, we've worked with Huntington and we've worked with Burford, and I can speak from personal experience that they're both outstanding partners for this sort of thing. But the direction that you go has to be based on how you feel about the risk and the assumption of the risk, and also how much you're willing to pay at the end of the day for that financing. And the third aspect that I mentioned, which in some ways can be the most important, is what are the ethical restrictions, if any, on what we decide to do. That can vary, as you've already heard, jurisdiction by jurisdiction. The rules in Texas may be different from the rules in California, may be very different if you ask the New York City Bar Association from how they are here in New York. Of course, as lawyers, just like funders do, we need to navigate those situations in order to make sure that we are complying with the rules. And more than just varying from state to state, we see that they vary from country to country. We do quite a lot of work outside the U.S., and if you take a country like Germany, in Germany, the contingency fees are simply illegal. So we can't do in Germany what we do here, which is offer to work for our clients on a contingency basis and advance the cost in exchange for a percentage of the funds. But there's a very robust third-party funding market in Europe, and so our clients still have the option to get a similar package to the one that we could have offered them here in the U.S. by working with a third-party funder like Burford, with whom we do a lot of work in Germany, and be able to, from their perspective, still have a risk-free way to pursue their claims.
Do you have to disclose to the court whether or not you're doing third-party financing?
It's a great question, and among the ethical issues that we confront with third-party financing here in the U.S., one is, of course, is it permitted at all, and if it is, how do we structure it in a way to comply with the rules? Are there some jurisdictions where it has to look more like an interest rate or a multiple as opposed to a percentage? Possibly yes. I think, as Marc said, the disclosure question is a really important one. We've seen some courts, like the Northern District of California, adopt a new rule where in class action cases, sources of third-party funding need to be disclosed at the outset of the case. There's even a way that you could read the standard disclosure of interested party rules to require identification of third-party funders in many jurisdictions. I'm not sure how often people think about the implications of some of those Rule 7.1 disclosures on this. So disclosure can be really important, and what it kind of goes into is if people are reluctant to disclose the existence of a funder, one reason may be because they're concerned about discoverability of funding agreements and the injection of those issues, communications with funders and so on, into a litigation. The courts have been pretty uniform in ruling that those sorts of communications are not relevant or discoverable in litigation, and there's certainly a case to be made that transparency of the involvement of funders, particularly in class actions, is a good thing, not a bad thing, and in some ways maybe it should come a bit out of the shadows and take a more prominent role as an additional option beyond those that have been more traditionally used in class action.
So if Judge Rakoff were here, he might, in a lead plaintiff situation, selecting between different counsel or their clients, want to know whether or not there is such funding, but he would do so in camera, I assume. But have you been in situations with lead counsel fights where the courts have made that a criteria?
Well, I've certainly seen courts make as a criteria, and I think it's actually part of Rule 23, which is the ability of applicants for lead counsel to finance litigation, and that is not defined in terms of, what does it have to look like, and so I don't see any reason why access to external sources of capital, be it bank financing or third-party financing, wouldn't be a way to certify it. And more recently, I think judges are seeing that there really is a third-party funding market out there, and that some plaintiffs' firms are going to that, and specifically asking at the lead counsel phase about whether there are any third-party funding arrangements. I mean, indeed, one reason why it's so difficult to use third-party funding in the class action context isn't just the disclosure issues, but also questions of consent, that in a normal single plaintiff situation, you would of course need the client's consent to be able to accept compensation from someone other than the client. Questions about how to do that in a class action context are quite interesting and do present some unique challenges, and perhaps that underscores why transparency with the court is even more important, because if there's anyone who has the fiduciary ability to consent to such an arrangement on behalf of absent class members, it would be the court.
And as I understand it, there are certain situations where Burford would get involved with dealing directly with the client as opposed to the law firm, so that may be another option on the menu, so to speak.
Right, I mean, a lot of our relationships are directly with the client through the law firm, sometimes directly with the client. Less so in the class action space. I mean, generally speaking, we're talking a big corporate client that has litigation where we have the direct relationship with the client. It's a completely fair point that in the class action context, it's a little trickier.
Marc.
Since I'm also at Berkeley Research Group, we supply experts in litigations, disclosure becomes important to us in certain cases. Recently, I was involved in a case where we had individuals who were plaintiffs. It wasn't a class, it wasn't big, but it was necessary for us to be willing to offer experts to know that they would get paid, that disclosure of the funding agreement was necessary to us. And the law firm was forthcoming in that, because they realized there was very little chance that they were going to be able to hire an expert otherwise.
Yeah, that's a very good point. Are there
Yeah, I think one of the questions that come up in as a manager of the firm is, what is the timing of payment of experts? It's one thing at a class certification stage, it's another thing at trial, because if there's a payout over a period of time for an expert, that's something a little more manageable. So there are questions sometimes that come into our consideration as to how experts. In an antitrust case, I would imagine that given the amount of money that is necessary for a antitrust expert, that I assume that the expert is going to be paid in full at the time of the testimony before the court. Usually, and it is a function of whether or not you're testifying as opposed to submitting something in support, and there may not have to be testimony in court.
Yeah, let me just hop back to the perspective of the financiers. Is anytime you talk about access to capital, you're talking about, a thirst for a high return. So having said all of that, I guess a question for Liz and Christine, are you seeing other potential entrants into your space, such as from hedge funds or private equity players, et cetera, that you might have to contend with going forward?
Yes.
Okay.
So, in recent years, there has been a big uptick in, as the private equity hedge fund side of things, who saw, this is Burford's 10th year, and they saw the returns that we were making across our portfolio wide. We're at about a 30% IRR, and that's sort of eye-popping to some folks. I think the problem with that is what we do to diligence the case, the database of information we have, our ability to assess risk is a full-time dedicated process for over 100 people, and so you can't dabble in this space. You really have to kind of dedicate yourself to it, and so I think a lot of these hedge funds that are dabbling in the space will make a few bad decisions at some point, and some will fall aside, some will not. They'll be successful. Competition's not a bad thing. I guess my one cautionary note would be you have to be careful about what your source of capital is. I think some of the funds that are out there calling themselves funders are actually more like brokers, and so they will come to you and say, we want to finance your case. You say yes, and then they have to go find the money. The other thing with a hedge fund or private equity is they usually have kind of a time frame at which they want their money back, and it may be 3 years out, and so they can't kind of go the distance, and they may have kind of disaligned incentives somewhere during the course of the litigation. We are publicly traded. We have balance sheet capital that can go the distance. There are others in the space that are publicly traded and have that same kind of advantage of being able to really go the decade that sometimes it takes in these cases to go to the end.
Yeah, and so Liz, from your end, I mean, there's lots of banks that can provide bank financing generally. Why is it that Huntington has the market share that you have, and why aren't others getting into it?
Well, it's nice of you to say that. We at Huntington have been together as a team. Actually, our core 4 people on the National Settlement Team have been together since '02 with a prior bank, and now we'll be coming up on our 10th year anniversary with Huntington. So we're very proud of the fact that we're a cohesive team that has been dedicated to this space for many years. It takes a long time to actually learn and understand the gist of all this, and it takes a long time to trust the people that you're working with as clients. Again, it's character loans. We're relying on future settlement funds, but they are predicting those in a conservative fashion, and they're estimates. So there's going to be mistakes made. We're all human, and we understand that. So we want to give leeway for that. I think the fact that you'll see other banks from time to time in this space, there's distinguishing factors. It depends on whether or not the team is truly focused on the needs of the firms, or if they're approaching it, as I said earlier when I started my conversation, that maybe they were looking at the wealth management aspect first, and then the firm was more of an accommodation. We are the opposite of that. So I think that we're sensitive to pricing. We're looking at making sure that the pricing is not going to hamstring the firm from a cash flow perspective, because we know some of these cases are going to take months, if not years, to go through the complete cycle. I was recently at a litigation funding event a few months ago, and there were several players in the room, some of which were trying to be like Burford, but they were nowhere near the caliber of what you provide, Christine. And there were many in there that were not at all experts in what I would call the plaintiff or legal industry at all, because there are some third-party funders that are doing the defense end as well as the plaintiff side, so there's a distinguishing factor there too. But one common theme that I found during that conference was the fact that it is truly nascent. This is somewhat in its infancy at this point, the notion of third-party funding and how it's being used, the amount that's being put out there. So it's attracting eyes, as you put it earlier, because of the fact that there's a lot of capital to be deployed in this market right now. And anywhere that people can find something in double-digit returns, they want to look at it. I think what really has to happen, though, it has to be completely vetted by people that understand the nature of the cash flow cycles of this business before they can really start addressing what's the potential value upon exit. This is not going to be an IPO strategy. You're not going to have a class action law firm, in most cases, maybe there's 1 or 2 out there that did it, that are going to go public. So it's a different type of play and a different monetization. So it's very specific.
Marc?
Well, I'm curious from an international litigation standpoint. I've always heard that there's insurance litigation offered in England, Australia, I don't know about Europe, as opposed to the third-party financing. And what's going on there? Because I'm going to be speaking at a conference, but also firms are looking more towards an international landscape now. So can you speak to the difference between insurance versus financing?
Well, I would say they used to be more different than they are today because we've seen a bit of a convergence with the third-party funding and the insurance markets in some sense. But depending on what jurisdiction in Europe you're in, the adverse cost regime may be a very significant factor when it comes to assessment of those risks at the outset of a case. Here in the U.S., we don't have a loser pays regime except in a small group of cases. Well, actually, the defendants have a loser pays regime, but we on the plaintiff side generally don't face those sorts of risks to any material extent. If you go over to the UK, then actually the adverse cost consequences of losing a case as a plaintiff can be extraordinary, especially if you are dealing with a multiple defendant complex case that may go over years. And so the availability of what are called after the event insurance products can be an essential part of the overall financing. And when you work with a third-party funder, one of the things to discuss is who is assuming the risk for potential adverse costs. Often the funder will step into that role, but often that will be combined with, just as we would go out to get after the event insurance, the funder would as well. And there are some funders that actually now have as part of their portfolio of offerings, as Burford does, insurance products.
So, obviously most of the deals we're talking about are with plaintiffs' firms, but Christine, can you maybe describe, is there a small portion of the entire financing portfolio where you're dealing with defense cases, and if you can describe like how that actually would work?
Sure, and actually I think it's a little bit of a misconception that we're usually working with plaintiffs' firms. We work with about 80% of the AmLaw 100 law firms because most big corporate clients have affirmative litigation in addition to defending claims. Sometimes they haven't typically brought them, but if they can have financing behind them, then they're able to bring those claims and monetize those assets. And so, we are working with law firms ranging from, the top in the world down to more boutique firms of 2-3 people. So we really work across that base. We certainly, we provide financing in defense side cases in a number of different ways. The obvious one is part of a portfolio. So if a client has a lot of litigation, some of it affirmative, some defensive, we can provide capital that they can do whatever they want with. They can grow their business, they can use it to hire more people, upgrade their technology, whatever they'd like, and our return is coming out of those affirmative cases. The other one is if there's a counterclaim in what started out as a defensive case, but there's a counterclaim. And we do fund defense side claims. It requires a little more creativity in coming up with ways to do that. It typically is based on some sort of predefined measure of success, and that may be time-based. It may be what exposure you have versus what the actual resolution looks like, and then our recovery kind of is predefined based on those success measures. And so there really isn't any matter that we can't at least kind of try and work through and be creative and figure out ways to solve whatever the problem is that they are coming to us about.
Yeah, I'm actually working with several of Christine's Burford colleagues in thinking about is there any way in working with higher education, major research universities that have very, very significant research and development and IP portfolios. And at the end of the day, litigation is really not on a college president or a college CFO's radar. So is there any way to help them manage that risk, in a going forward perspective? So we're in the process of doing that.
Yes,
some of your DC
monetizing
colleagues.
patent portfolios is because a lot of companies, not just universities, but companies have thousands of patents sitting on the shelves gathering dust, and they can be valuable
They want to make that valuable, exactly. I am told that we have 5 minutes left, and at that point, does anybody in the audience have comments or questions or feedback?
I believe that recently there was a decision came down from a New York State court that the interest rate charged by finance companies is not subject to or usury laws. And I'm not sure what the status of that litigation is. Was that a Court of Appeals decision? Do you know? Or
I don't know that specific case, but generally speaking, our financing is not subject to usury laws because it's non-recourse, so it is not a loan. It is an investment of capital, and so what the ultimate interest rate might look like on the return, even though we don't view it as an interest rate, is not subject to the usury laws.
And regarding the matter of pre-filing, would you finance a matter before the complaint is filed, or do you generally wait until the action has been started?
We do fund cases that are pre-filing. It's riskier. We certainly would want it to at least be worked up as far as the claims are pretty clearly laid out, the jurisdiction has been selected, counsel is in place, and then we would have some long discussions with counsel about strategy and budget and the like. That's going to be priced more expensively because it is so early on in the process. We do not fund when someone comes with us with sort of a conceptual idea that I think I've been wronged. That's going to be too early in the process. But if it's pretty well worked up, maybe even a draft complaint or at least a strategy memo, then we can consider it.
Sure.
Can you just address briefly the ethics issue here, because the elephant in the room is sharing of fees with non-attorneys. You just mentioned as a way of maybe circumventing that issue is by an interest rate that is non-recourse. But I'm curious as to how you are handling that issue, because obviously you haven't been shut down.
No, we haven't. In fact, we committed $1.3 billion in capital last year, so, and I don't think we're going to get shut down. It is a very important issue, and it is one that we are very sensitive to. The courts largely have found that it is not sharing in the fees of a law firm any more than when you repay your bank. That is sharing in fees of the law firm. There are still many discussions about that going on, especially after the New York City Bar Ethics Committee came out suddenly last July with an opinion saying that in fact it was not ethical to do a deal with a law firm. It is a non-advisory opinion, and there are a lot of discussions going on about how to kind of deal with that. The committee admittedly said they were trying to spark a discussion, and I think they have sparked a discussion. I think from our standpoint, it's kind of slowly everybody's getting more comfortable with the idea as the industry grows. And so that's things that will be sorted through, certainly jurisdiction by jurisdiction. But I think generally there will be parameters guiding the ethics of it. And then we take them very seriously and keep very close track of it to make sure that however we structure our agreements, that they are, we are not asking the lawyers to do something that is unethical, because at the end of the day, that's whose ethics are on the line. So.
Yeah, it's very interesting because everyone agrees that it's perfectly fine for a law firm to go to Huntington or another bank and take out a line of credit and use that money to finance cases based on the strength of their portfolio of cases. And what's so odd about this New York City Bar opinion is that even something that I think just about everyone would have thought was innocuous, which is interest rate-based non-recourse lending, which is really just half a step removed from what the bank does, all of a sudden crosses into being an unethical practice, which is, it's just totally wrong, and it'll get fixed at some point. The more interesting questions are about well, what about a deal if you want to have the funder take a percentage of the fee? You know, I think you can have an interesting discussion about that and how best to structure that if you can in different jurisdictions. But that's not even the discussion that we're having. We're having a discussion about is non-recourse okay, which is something.
You know, and on that note, we can probably do an entire day conference on some of the more arcane topics related to litigation finance. But, you know, thank you, Liz, Christine, Marc, and Brent. I hope everybody gains some value from this discussion. And feel free to reach out to us.
Thank you. Great. You've reinvented yourself very well, or you've taken